This is Lori Elliott with Conceptually. Today I want to share with you how we bring capital to your venture or your project. We call it collaborative capital. Let me share what it is and how it works for you. First of all, I just wanted to give a general definition about what we mean by collaborative capital. And I'm going to first start with what collaborative capitalism is. This is an economic model, policy approach, or development strategy by which an individual's, investors, corporations, or country's economic interests are best served through a proactive strategy that seeks to improve the well-being, economic power, and capabilities of other individuals, corporations, or countries. So simply put, it really means sharing so that everyone benefits and everyone gains wealth. So this is not crowds, though. This is not about crowdsourcing and crowdfunding. Many of you may be familiar with this. Crowdsourcing is the practice of obtaining needed services, ideas, or content by soliciting contributions from a large group of people, and especially from the online community. Crowdfunding is essentially the same thing, but instead of the other items, it's a collection of funds. And even today, there is now what they call equity crowdfunding, so that those that you ask to contribute can actually share in the ownership of your company. We actually don't use the crowd approach. We actually think that there is a use and a place for everything. Our space is quite a bit different because we not only want to have the momentum of crowds, we also want the discipline and commitment of collaborators. So this is where we come in with collaborative capital. So collaborative capital to us is where a defined group of people and organizations input various forms of capital to build value and wealth from which they will benefit directly. The structure that we use and call it is collaborative wealth vehicle. So when we look at this, what do we mean by collaborative wealth vehicle? Basically, we call it a storehouse or a treasury or a new asset formation. But it's very simple. If you look here at this visual, you will see in the middle there's the venture. That's what you're bringing forward. You're putting before us a venture or a project, or you're a collaborator who's interested in a venture or a project. And then in order for that venture to grow, for it to be cultivated, for it to be sustainable and viable, it needs certain resources. And so here's an example of what those resources could be: equipment, intellectual property, talent, professional services, channels, working capital, facilities. Now, notice this. It's not just cash. It's just not liquid assets. So when we're talking about capital, we're actually talking about many forms of capital, not just liquid assets such as cash or metals, or gemstones. We're actually talking about a full range of resources that are available to an enterprise, to a project. And what makes all of that come together? It's your stakeholders. It's people and organizations who are making a commitment of their resources to your venture. And so this is what we mean by collaborative wealth vehicle. It's first of all a group of people and organizations bringing together resources to support a venture so that it can grow and that they can receive benefit directly or indirectly. Once that's done, the venture is now, when all of these things are combined, it's actually a new asset formation. It's actually a new organization that has increased value. And the goal of it, of course, is to develop so that it will increase in value, it will generate revenue, it will generate profit, so that those that are now beneficiaries, those that have contributed, now also become beneficiaries, and then they are able to share in those rewards. So really though, to make this work, this is again which kind of distinguishes us from traditional investments or from even crowds to a certain degree. Um, the characteristics of collaborators in this model need to be passionate, have a purpose, participate. There is no passive investment. There is no just putting money in, and then just waiting for it to grow. there is a level of participation, a level of willingness to work to see that the venture grows. Now, some of you may be a little bit worried. You're thinking that, oh, that means I got to spend a lot of time. It's not necessarily a lot of time. It's something, when we think of contributions or participation, we look at it from a strategic perspective. What is going to help this venture grow? How, as a collaborator, can you participate in that? And it's not really ever about money. It's about all of the other resources, the people and organizations that can come together to provide the support, the ecosystem for a particular venture. So, in addition to participation, people may be bringing proficiencies and their professions. A really good example that we have is that on several projects we've seen where accountants or law firms have actually contributed their services in order to share in the benefit, or because they just loved what was happening, they did it as pro bono in order to see the benefit of that venture reach others. And then there's prosperity. Prosperity is sharing in your treasure, whether it's equipment, facilities, cash, in order to help that venture grow so that you and others can receive benefit. So really it's a shared model. It's not a transfer of wealth in the sense of, just shifting wealth to other people, but it's a means of helping everyone participate in the process of creating wealth or building value. So before we get into the details of what all this means for you, let's first talk about the types of capital, because this is where people often get hung up. Definitely, there is economic capital. That means cash. That means any financial instrument, whether it's debt or equity, that allows you to get access to working capital. Liquid assets. You might have jewelry. You might have anything that can be readily exchanged for cash or for operating concerns. So that is something that's not going to away. That's going away. It's a part of the way that we do business. But if you want to be able to access the full amount of resources that can be available to you, you're going to have to expand your understanding of what capital is. I think also that many of you will recognize social capital. That's where you have connections or relationships with people who can open doors for you and give you access to those, or um, directly to the resources, in order to use them on behalf of your venture. Now, a lot of people look at that and they're always, concerned, because as a society, for some reason in this global society, we become so transactional that we think there's something wrong with having a relationship and someone opening the door for you. We're not talking about nepotism. We're not talking about any illegal means to gain access to getting the resources. We're talking about relationships where they can see that you're providing something of value and they want to help. And there is nothing wrong with social capital. The next thing is spiritual. Many people will say, well, you have to separate, the spirit. It's not something that you talk about. But in reality, where does the power come from for you as a venture founder, or even as a collaborator, to participate and commit to something? It comes from your passion and your purpose. And where does that come from? It doesn't come from anywhere other than your heart, the very center of who you are. And that is what really drives someone's ability to be able to carry through and do what's necessary to bring a venture into its fullness. It's not just about the external stuff and the things that you do, it's the power that's within you to create, and to create something of value that will benefit you and benefit others. There, of course, is knowledge. I think that's straightforward. We understand that there's intellectual property. There's knowledge that we gain over the years. There's knowledge, for example, of markets that you gain by being a participant in that market, or being a firm in that particular industry. There's political capital. That happens to deal with not so much necessarily the formal structures, of knowing someone who's in charge of something. It's certainly one aspect, but the second part of that is that it's also informal. Political capital simply means those having influence and access to those who are decision makers. Environmental can be related to land, but these days we're really talking often about the green economy. We're talking about opportunities to um, develop value that is green. Okay, so if your solution, for example, is a green solution or uses and implements green standards, for example, you may have access to more investors than others would. Good example. Um, in energy, we see the trend now where, for example, a lot of like the US programs in Africa to support and even provide funding for power is still being driven by the idea that they want to see green power. So if you wanted to build a coal plant, it's not that you couldn't necessarily get funding or support, but that is not their primary agenda. So this is just one example. Another environmental example is when we're talking about climate change, is that if you are stewarding land and you have quite a bit of land and you plant trees, you're actually contributing to the health of the global environment. And so you might be able to get cash for the fact that you are serving as a good steward. There's also a creative, which is also part of intellectual property. It's something that you've created. In fact, this idea, your venture, is actually creative. Even if it's not, artistic or abstract and all of that, it's still creative because it takes creativity. Really, creativity is the power to take something from an idea and implement it, to conceive it, to birth it, and to nurture it. We also talk about positional, and that really has to do with the roles that you serve. So, for example, you might be, hold a position in one organization and a different type of position in another organization. And each one of those, actually, because of where you are strategically in those organizations, you have certain access to certain people and certain resources. Institutions, it's very good to have institutional affiliations. A simple one that many people will have is their university. When you graduate, you become an alumni, and there is a lot of institutional capital in that, and some of it's tied to social capital as well. So, for example, a lot of the larger universities, long-standing, been existing for, a couple hundred years, they have massive alumni networks that are very influential and provide access to members or to people who have good affiliations with Duke alumni. So, also physical. That has to do with the power of your body. Being in health, being able to, endure the work that it requires to bring a venture forward. All of those things become a form of capital. Generational. There are things that your family may have taught you, maybe, just intellectually that you just know because it's been in your family for centuries or for generations. So I think of another example. We have one investor who's interested in agriculture, and the reason that she is because agriculture and farming has been in her family for probably 4 to 5 generations. And so for her, that capital, that understanding, that passion, that purpose is all bound up in the generational legacy that's been left through her family. And then finally, there's closeness and relational. Closeness really is about the ability to develop intimate relationships, because when you have that position with a particular person and they're a gatekeeper to certain resources, they generally will open to you and help you where others would not, even if they don't necessarily agree with everything that you have to say. Because you have that level of relationship, they're willing to take the chance and give you the opportunity. And then, of course, relational, as I said, that this has more to do with actually, are you in relationship with others in your industry? Are you in relationship with those above you in your organization or outside of your organization? So all of these are really just examples of types of capital. This was actually put together by Bruce Cook of Kingdom Ventures, but you can imagine now the diversity of capital that you can come away with. So the idea here again was to expand your understanding. So let's just quickly review this. So for each person, they have a unique set of capital. They might have certain economic, social, creative, knowledge, and institutional capital. Now, if it's in a group or an organization, you now have many sets of unique capital. And as you begin to synergize this, it becomes like a tapestry and an ecosystem that supports your venture. Now, why do we emphasize this so much? When people typically go to get capital for their organization, it's more of, oh, I got to do it now. There is really no plan to it. Basically, what we're saying is from the time that you conceive of your venture and whatever stage you're at now, you should have an ecosystem that is helping to bring resources into your organization. Now, for example, mature organizations, they've gone through this, they've got those ecosystems, and typically, they can reach out and get resources that they need. But typically that doesn't happen. I mean, that takes years and years. So what we do with you is we work alongside of you as you are working through the process of moving to the next level in your venture so you can access more resources, partnerships, and capital, and help you to develop and synergize those components so that that ecosystem is always at work for you. And that's very important. So then basically you can develop a capitalization strategy that will help you now, will help you next year, will help you 5 and 10 years from now. So when we talk again about, we talked about capital as it relates to resources, but let's talk about the stakeholder part just for a moment. And with stakeholders, we find that there are stakeholders within the corporate realm that are internal to you. That would be you, your team. It could be your board of advisors, your board of directors. And in that case, all of those individuals actually also have unique sets of capital. And you should be able to call upon those individuals to help you find the resources you need for your venture. Then you have collaborators who may be strategic partners who are very close to you. They may actually be helping to provide a specific component in order for you to deliver your product. These relationships are a lot closer than the general public or the crowd, if you want to call it. You then have your channels, and those channels are those which help to deliver your product or get word out about your product to your end user. There's also customers, of course, and then there's a broader community. Now, why do we mention all of these? There is a shift in the way that companies are becoming sustainable. It is not just about shareholder value, those that have put in financial interest, but it's the whole spectrum of stakeholders. And this is a real major shift. It's going from just looking at what we already have. And this is really important because in the world today, everything is chaotic, it's turbulent, it's always changing. There are new innovations, and there's always going to continue to be creative destruction. I don't see that this is going to slow down. So our environment is no longer the place where you can just, develop a business and that you do the same thing forever and never change. You're going to end up having your venture die. Okay, and so the idea is that basically the shareholder value is really trying to maximize off of existing value. It is not really focusing on strategic value creation, the continual process to increase value for stakeholders. And so this view of what we're talking about, the collaborative capital, is really focused on that. Not that financial investors are not important, they are. Not that you are going to not be required to in cases, not necessarily with us, still be required to take debt structures or equity. But the idea is that you want to account for all of your major or all of your key stakeholders. And so this is the process, the way that we do this by working with you to identify different sources of resources or capital. That would be stakeholders. And we work with you to do that. We show you how to do that for yourself. We show you how to organize them, how to work with them. And it all then also leads into stakeholder relations and investor relations and even public relations. So the foundation of what we're doing is something that will help you interact with your whole web of stakeholders, your customers. And so basically, this is something that when you put in the effort to do it, it's something that goes along with you. It's not just to get money, in the next 3 months, in the next 6 months. It's something that you carry with you so that you can continue to get resources, but there are also many other benefits from it as well. So why then? So we talked about capital. We talked about the first of all the collaborative wealth vehicle, and then we said the key components. There's the venture, then there are resources, and then there are stakeholders. Well, really, why would people want to be a part of the collaborative wealth vehicle? Why would they want to participate in that? Basically, it's because when they contribute or when they participate in it, they're expecting to get something out. Now, some of them, they may just do it again because it makes them feel good and they don't necessarily need a financial return or any what quote unquote tangible return. But it all still goes around the concept of what is your business? What do you do? What is the value you provide? And even with the stakeholders, when we talk about collaborative capital, it is still about value and creating a system so that people are contributing and people are benefiting. So just a definition here for a business model is a business model describes how the venture or project logically creates a reciprocal exchange system of value for stakeholders. I'm not going to go into the other parts. You can certainly, look at that in more detail. But also, again, remember we talked about the difference when you're talking about stakeholders versus shareholders. It has a lot to do with strategic value creation. And so the process when we're talking about collaborative capital is that you're going to see that there are going to be myriads of opportunities to create new things, to create new value, to build on the value that you have. Um, People will be able to come to you and give you opportunities because you're affiliated with someone that they know. And again, think of that compared to having to go out to find a new market, trying to, come up with new sales and new customers. So really we're looking again at this web, this network, but really we call it an ecosystem because that's a tighter interdependency and interaction. And so really that's what you should be seeing from anything that you're going through in order to get capital, in order to develop your venture, to be sustainable, to grow your venture. You should begin to see these things begin to circulate. And so what we do is we ensure that you are building a system of this so that all of these pieces begin to work together and then obviously help support the growth of the venture. So what does a reciprocal system of value exchange look like? This is actually very easy, but I just want to give you a visual to hopefully get it set in your mind better. You have a venture, you have many different key stakeholders who will participate at some point. In this particular example, this is on an energy project. It might be a power plant. So you obviously have the users who are going to purchase energy from you, and so therefore then you're going to get revenue back from them. But you might have a situation where you are putting in a new power plant and you need workers from the local area. And so a government or a private institution or a NGO says, we will actually train them for you and we will not charge you for that because it is a part of their mandate and they have the resources to do that. That then saves you the cash in having to do that. Now, the way we like to work is we believe that if everyone's participating, when something begins to move and it does generate revenue, then we should be giving back or putting back into those that have put into us. So this is a little bit different. Not everyone does this. And it's not necessarily required because obviously we're working for the good of everyone, including the venture. Doesn't help if the venture, can't sustain itself. So, so all of this is in balance. But in spirit, the goal is to really create a system of value that exchanges value for every single contributor that when they put in, they're able to get something out as well.